The past week has seen Australia's major banks report a batch of earnings, and today I'm joined by Morningstar's David Ellis, who's here to give investors a better idea of how the banks are actually travelling. David, thanks for your time today.
Nick, it's a pleasure.
David, first out of the gate was National Australia Bank, whose result you said was disappointing and messy. What was behind your particular disappointment?
Well, it was pre-announced, so there was a large amount of provisions and write-offs that were announced in early October. So that's really what the disappointment was. So that was 1.5 billion after tax. So NAB's profit was down 10% compared to 2013. So that's disappointing, of course. Messy because there was quite a few moving parts as far as the write-downs and extra provisions that were taken. There's restructuring occurring. There's the ongoing problems in the UK. There was some glimmer of light and hope in that the new CEO, Andrew Thorburn, made it very clear that the exit from the UK is going to happen sooner rather than later. So I would expect within the next 12 months, which would be a very good outcome for NAB.
David, next in line was ANZ, who you said put in a high quality performance. What did you find most pleasing about its result?
Well, ANZ was up strongly right across the board. So we saw good revenue growth, saw strong lending growth, deposit growth, costs were relatively well controlled, bad debts were down, which is a similar story across for all four major banks. Return on equity was up a touch. Capital was up reasonably well. The super regional growth strategy, so expanding across Asia, that's coming to fruition. It's unfolding nicely. Revenue and earnings from the Asian region are increasing, and most importantly, the ANZ CEO, Mike Smith, reconfirmed their 2016 targets of return on equity of 16% and a cost to income ratio below 43%. So on track, pretty clean result and strong right across the board.
David, you said you found a lot to like in Westpac's result, particularly its improving asset quality. Why is this important?
Well, it's very important for the banks because asset quality or bad debts have major impacts on bottom line profits. So Westpac has for the last 20 years or so has had the best, what we believe anyway, the best credit risk management of all the four major banks, and has the lowest amount of bad debt expense compared to their average loan size. So and that's continuing. We're seeing good credit quality or loan quality at Westpac right across the board. So in their institutional banking, their business banking, and importantly in their consumer banking, which is dominated by home loans. So they have the best loan loss record of the four major banks. And also another reason why I like the Westpac result is Westpac has is the most efficient of the four banks. So it has the lowest cost to income ratio. So that means it has the highest operating leverage or gross profit generating ability of the four major banks.
Finally, David, we saw CBA release a first quarter update and Macquarie release its first half earnings. Can you just give us a brief idea of how these banks are travelling?
Well, again, they're performing very well. Macquarie, of course, is very different to the four major banks, being Australia's only global listed investment bank. It had a very strong first half 2015 result, that's 6 months to 30th of September, up strongly right across the board, primarily driven by their funds management business, their global funds management business, very strong performance. Obviously, the recovery in investment markets around the world and the IPO markets, particularly in Australia, have benefited Macquarie, and we expect further strong second half result for Macquarie. Now, Commonwealth Bank, as you said, it was only a trading update, first quarter 2015 trading update. Profit of about 2.3 billion unaudited, which is On track to meet our full year profit number for the 2015 financial year of 9.2 billion, which is a strong all-round performance.
David, thanks very much for your time today.
It's a pleasure, Nick.